Next is the income statement. The income statement is commonly referred to as the profit and loss statement or the P&L statement. And it shows the activities of the firm, and it provides a statement that shows the changes that occurred in the firm's position as a result of its operation over a specified period of time. The income statement categories are revenue, which is gross sales for that particular period, expenses, cost of producing goods or services for that particular period, which leads to net income or net loss. Net income is when revenue is higher than expenses, and net loss comes when expenses are higher than revenue. So let's take an in-depth look at the income statement. Sales revenue, cost of goods sold, operating expenses, financial expense. Every time a business sells a product or service, it obtains revenue. Revenue is often referred to as either gross revenue or sales revenue. As we see in our example of the income statement, sales revenue is represented, but it is subtracted by sales, returns, and allowances. This deduction is an offset for merchandise that is returned or discounts that customers have taken. The cost of goods sold section reports the cost of merchandise sold during the accounting period. This is what the company buys the inventory for. When the cost of goods sold is subtracted from net sales, it results in the gross margin. The gross margin is the amount available to meet expenses and to provide some net income for the firm's owners. So here in our example, we see that revenue totaled $1.7 million. Our cost of goods sold was $1 million, leaving a gross margin of $700,000. This $700,000 will now be used to pay any operating and financial expenses necessary for the organization. The operating expenses become the major expenses exclusive of the cost of goods sold that the organization has in order to operate its business. So selling expenses result from activities such as displaying, selling, delivering, and installing a product or performing a service. The cost with getting the product from the store to the customer is also considered a selling expense. Administrative expenses are all the operating expenses not directly related to selling or borrowing. It includes the salary of managers and other expenses associated to office and general expenses, again, not related to the buying and selling activities of the firm. The financial expense is the interest expense on long-term loans. The estimated income tax represents the amount that may be due at tax time. So after the operating expenses, the financial expenses, and the income before income tax are subtracted, you then are derived at the company's net profit. Next is the statement of cash flow. The statement of cash flow is an analysis of the cash availability and cash needs of the firm that is reflected in three different sections: operating activities, investing activities, and financing activities. With the statement of cash flow, you can assess how much cash your firm generated from operations. How did the firm finance fixed capital expenditures? How much new debt did the firm add? And was cash from operations sufficient to finance fixed assets purchased? Let's take a deeper dive into the cash flow statement. The operating activities section report a summary of cash receipts and cash payments from operation. The net cash flow from operating activities normally differ from the amount of net income for that period. The difference occurs because revenue and expenses may not be recorded at the same time that cash is received from customers or paid to creditors. So an example of that would be information that's on the accounts receivable and or accounts payable. The investing activities section reports the cash transactions for the acquisition and sale of relatively permanent assets. And lastly, your financing activities reports the cash transactions related to cash investment from stockholders, borrowing, and dividends. Now let's dive a little bit deeper into the cash flow statement. As we see here on the statement of cash flow, the cash flows from operating activities is represented as $50,000. What this number is representing is the cash inflow that exceeds the cash outflow. Next, we see a negative $10,000. This number can be either a negative or a positive, and it just really depends on what the activity is at that particular point in time. For this example, the firm decided to repair a fixed asset, and therefore it's showing a negative cash flow from investing activities. Lastly, you see financing activities. For this, it's $5,000. This financing activity represents either a sale of a new security, stock or bonds, or a repurchase of a security or payment of a dividend. And it's represented as $5,000. The net increase in cash is $45,000, and our beginning cash balance is $400,000, now bringing our cash balance at the end of the period to $445,000. Because this statement is frequently used to analyze the firm's financial position, business owners can use the information here to create their cash budget. So we'll talk a little bit about budgeting next.